Hello everyone, I'm John with JP Strategic Investments, and today we're going to talk about some recent news that JP Morgan has issued a new structured investment made up of ARK ETFs. I'll go over exactly what this structured investment is, how it works, and what my opinion of this investment is. So let's dive right in. So Bloomberg reported a couple days ago that JP Morgan had issued $589,000 worth of structured products tied to exchange-traded funds from ARK Investment Management. And then according to the prospectus, these notes offered 1.5 times leverage on the ETFs over a 6-year period. So for any of you unfamiliar with how leverage works, basically this means that the investor would make 1.5 times whatever the return of the underlying asset is. So if you own these notes and the ETF went up 100% over the 6-year period, then you would make 150%. The notes are linked to 3 of ARK's ETFs, ARK K, which is ARK's Innovation ETF, ARK G, which is ARK's Genomic Revolution ETF, and ARK W, which is ARK's Next Generation Internet ETF. ARK's ETFs have had a great run over the past couple years. And on a fun side note, just days before this news came out, ARK's Innovation ETF passed up JP Morgan's top ETF, becoming the largest actively managed ETF. So you could say that JP Morgan here is taking the if you can't beat them, join them approach. A former structured product trader commented in the Bloomberg article saying that, quote, basically this is a sophisticated client's YOLO call option. You are striking when the market is at all-time highs. Now, when I think of a YOLO call option, I think of some next day to expiration lottery ticket on an earnings trade where the likelihood of success is very low, but you're going for the big payday if you win. ARK has a solid track record of successful investments, and they seem to be ahead of the curve when it comes to market research. That being said, I do agree with the fact that the market is at all-time highs, and right now Tesla, which is the top holding in both ARK K and ARK W, is trading at a sky-high valuation ahead of its S&P inclusion. So let's take a look at exactly what these structured investments entail and see if it's actually comparable to a YOLO call option. So if we look at the actual description of the notes from JP Morgan, we can see that the notes actually offer 1.5 times leverage on the return of the least performing of the 3 ARK ETFs. So basically at the end of the 6 years, you would get 1.5 times the return of whichever ARK ETF has the worst returns. This is a very important note here. Also, each of these notes costs $1,000 including commissions and fees. They also have a short section here with the main details on how the notes actually work. So basically, as I mentioned before, the notes are leveraged 1.5 times. So if the worst performing ETF of the 3 were to increase, say, 10% over the next 6 years, then the investor who bought these notes would receive 15% or $150, plus he would get back the initial $1,000 he paid for the notes. In a situation where the worst performing fund is equal to its starting value after the 6 years, then the investor just gets back the initial $1,000. Also, you may notice that they specify that if the fund is above the barrier amount of 80%, then the investor still receives the initial $1,000. This is basically saying that the investor doesn't actually lose any money unless the fund has dropped more than 20% at the end of the 6-year period. If the least performing fund drops more than 20%, then you would lose the same percentage on your investment that the least performing fund lost. There is also a table that offers a better visual of the hypothetical returns for the notes depending on different returns for the least performing fund. And just under this, there's also a graph that shows the hypothetical performance of the note compared to the performance of the least performing fund. For any of you familiar with options, this graph should look pretty familiar to you. So looking at this note in detail, I think it's one of the farthest things you could get from a YOLO call option. First of all, ARK's research and investments, in my opinion, are some of the best in the investment community. Second, these notes last for 6 years, and with ARK Invest targeting a 15% rate of return annually, these notes should offer very nice returns, and the likelihood of loss is very low. Third, even if somehow one of these funds does end up in the negative after 6 years, investors are protected for the first 20% decline. There are a couple downsides of these notes though. First, they are not traded on the open market and unfortunately are not available to every investor because of the complicated nature of the investment. Plus, they have already issued these notes, so if an investor wanted to buy one of them now, they would have to find someone that already owns one and broker a private deal. This also means that investors who have purchased these notes are essentially locked in for the 6 years, so if something did happen to one of the ARK funds and the investor wanted to get out of these notes before the end of the 6 years, it would be very hard for them to do so. I'm not sure exactly why JP Morgan is issuing these notes because in my opinion, there's a very low chance that any of these funds will go negative. But I'm sure they're going to hedge this in some way. They're probably buying these ETFs and using this as some sort of covered call. That way, if one of the funds doesn't perform as well, they can bring in a little extra money, but if they all do well, then JP Morgan still makes money. That being said, overall, I think this is a great investment product and will likely produce very nice returns. I hope you found this information and analysis helpful, and if you did, please consider liking and subscribing for more stock market analysis, and have a great day.